Hello, and thank you for tuning in to the MacDesk Floor Report for Monday, September 12th. I'm Rebecca Darst from the MacDesk, speaking to you direct from the trading floor. After a sharp Europe-driven sell-off on Friday that took Dow and S&P lower by nearly 3% and the yield on the U.S. 10-year note to a record low, futures remained under pressure for much of the pre-market this morning, and we were preparing for more of the same after the open. Now, much of the risk aversion on Friday occurred after the resignation of a key ECB board member from Germany, which was interpreted as a protest against the ECB's bond buying program in Europe, and following chatter in the markets that Germany had begun preparing contingency plans for its banks in the event of a Greek sovereign debt default. This was regarded as a sign that with the default scenario already on the table, an endgame may already be taking shape. This in turn turned the market's attention to France, where the country's largest banks are believed to have sizable exposures to Greek debt and where no such contingency plans have yet been reported. Rumors circulated this morning that a Moody's downgrade of the major French banks might be in the offing, and that chatter, along with news of an explosion at a nuclear facility in the town of Marcoule, contributed to sending the CAC 40 more than 4% lower today. But we made it through the weekend with no default. But a meeting of G7 finance ministers over the weekend, also in France, also brought no plan of action beyond a vague statement of support for the European banks. What we're left with is a market in the thrall of a grinding macro trade. A Bloomberg index of nearly 50 European lenders showed that these institutions are trading at just over half of book value. That's the cheapest valuation since the March 2009 lows. Earlier this morning, the spread between Greek and German 10-year government debt broke past 2,000 basis points. That's a record high. The yield on the Greek 2-year note, meanwhile, broke past 60% for the first time ever. And the 3-month Euribor OIS spread, which measures the willingness of European banks to lend to each other, hit its highest level since the market lows of March 2009. With insurers and money market funds continuing to cut their exposures to European and emerging market assets, this has created a strong bid for the relative safety of assets denominated in US dollars. And this drove the dollar index earlier today to its highest reading since February. On a positive note, however, Dow futures had been indicating a drop of more than 200 points off the open today, and we have bounced off the lowest levels of the pre-market, down just about 50 points in the Dow right now. And we've been helped along here by some M&A activity out of the tech space earlier today. VIX is up nearly 5% this morning, which brings us back above a reading of 40. And Goldman Sachs volatility analysts are advising clients today to buy October 40 calls on the VIX along with S&P index puts in anticipation of higher near-term volatility. Our colleague Art Cashin pointed out this morning that we have some key technical levels on the S&P today. Support levels to watch are 1140, 1132, 1120, and finally 1101. We expect traders to remain very nimble in the face of a fast-changing macro situation, and it's all being driven by Europe. For additional market insights, be sure to check your inbox at 1 p.m. for the midday. For now, that's it from me, Rebecca Darst, for the MacDesk Floor Report.